Welcome, everyone, and thank you for attending today's webinar. I'm David Shaw, the Publishing Director of Family Business Magazine. I hope that you, your families, and your employees remain in good health. We've all dealt with thinking about more deeply personal risk in the last 6 months. But these personal risks, many of them have always existed, maybe not pandemic risk, and those risks have been insured against. Given all that we've been through, though, it makes sense to take a deep look at what's happening in the personal insurance market for successful families and individuals, as well as think through family risk management strategies. Today's webinar is going to present some insight into these topics, and we'll look at options for protecting your assets. Some quick housekeeping details. We will have time for questions. You see the Ask a Question box that's right underneath where the speaker photos are on the left side of your screen. Feel free to enter questions or comments throughout the event. We'll get to as many questions or comments as we can during the 60 minutes that we have reserved for today's event. And of course, the presentation you see here will be emailed to you following the webinar, along with a link to replays that you can share with your colleagues. I'm joined by two experts today. Kimberly Frasca Delaney is a Senior Vice President Client Advisor in the South Pasadena office of Whittier Trust. She provides client advisory services to high net worth individuals, focusing particularly on intricate estate plans with complex legal structures. Joining Kim is David Beaton, Assistant Vice President and Private Risk Advisor with the Private Client Group at Willis Towers Watson. David provides consultative recommendations to families and individuals and implements customized insurance programs that are designed to protect tangible personal assets and personal liabilities while also addressing personal security concerns. So, Kim, can you set the stage for today's discussion?
I'd love to, David. Thank you. Good afternoon, everyone. Good morning on the West Coast. So David and I wanted to set the stage here. At the outset, we know most family businesses do not intend to also become the family office. Rather, the family business tends to take on various functions on behalf of the individuals gradually. These functions range from the somewhat routine tasks of paying the bills and household management to the more complex responsibilities of investment management, personal insurance procurement and oversight, as well as legal and tax planning. These additional duties can sometimes overburden the family business. So, in our opinion, personal insurance and the intersect between the business and the family often becomes an overlooked and underserved component of a total risk profile. However, taking a holistic and balance sheet-centered approach enables us to consider a family's overall risk management situation and can often help right the personal insurance ship. It also helps to reflect on where the family started versus where they are today. Sometimes families can outgrow or even outlast their team. Ultimately, the essential question becomes, does the family have the right people behind them? Today, our goal is to provide a personal lines marketplace overview. We'll discuss common risk management red flags and some considerations. We'll consider asset protection within the context of insurance, as well as present a case study or two. With that, I'll turn it over to my colleague, David Beaton, to give us the personal insurance market outlook.
Thank you, Kim. So in the context of today's conversation, we're going to talk more about the personal lines marketplace, the personal insurance in the context of personal lines, as opposed to what is traditionally maybe discussed in the context of a family business of commercial insurance. So initially, to kind of set the table, I just wanted to share an outlook of the personal lines marketplace. You know, it would be, I'd be remiss not to point out that we're in a hardened market. Capacity is down, rates are going up. Carriers on the personal line side have been taking an actively looking to remove unwanted risk from their book of business. while taking a much hardened and tightened scrutiny to the underwriting guidelines as they're looking at new business as well as review of their existing book. Given where we are with the pandemic, it would be hard not to at least make a comment on COVID as it relates to personal insurance. And candidly, there's been very little impact on the personal lines marketplace as a result of COVID, unlike what we've seen on the commercial side. What we have seen is some relief being provided to consumers in the form of rebates and refunds on the auto insurance side to reflect reduced mileage, reduced driving habits. We've also seen the roads with less automobiles on it. We will see, hopefully, a reduction of rate in the coming year to 3 years as a result of fewer drivers on the road. As far as rates and rate outlook goes, we have been seeing significant rate increases across the United States for homeowners and other lines of business. For homes under $1 million, we anticipate 3 to 5% rate increase. For homes over $1 million in the U.S., non-cat exposed, and when I say cat exposed, I mean exposure to catastrophic loss, fires, wind, hurricane, flood. We're seeing a 5 to 7% rate increase. Conversely, for homes that do have those exposures to fire, to wind, to flood, we're seeing a much more dramatic effect in the market. 20 to 50% for homes and exposures that have no loss experience, and a much higher 50 to 100% rate increase for properties and locations that have loss experience, have loss on record, and do have exposure to those catastrophic events. As a result, we're seeing a much more prevalence of the E&S, the surplus lines marketplace, in the homeowners insurance arena across the United States. This has had an impact on rates. The E&S market is not as confined by the Department of Insurance, and rates are a little bit more flexible, which is why they can provide insurance where other carriers have not. And if we look at the next slide, we'll see why we are where we are. In this slide, the overview is really showing the number of losses over the last 14 years, 15 years, and the number of losses exceeding $1 billion events. And what we've seen from 2010 to 2019, the number has more than doubled of events exceeding $1 billion in loss. And this has impact on where we are today. This is why we're seeing capacity diminished and why we're seeing rates increased. Carriers are struggling to find ways to maintain profitability in their underwriting, which is why they're looking at reducing and eliminating clients from their book of business with exposures that they don't have appetite for, and why they're taking rate to make up for losses. Specifically, 2017, 2018 were particularly bad for the private client personal lines marketplace in the United States. Next slide. This slide that we're showing here is showing market trends and specifically losses of water, wind, and fire, and this, the amount of payments made in the luxury private client homeowners arena. What we've seen is a dramatic increase, even from 2017 to 2018, for all major losses, fire, wind, and water. Water, I would highlight, remains and will remain the #1 source of loss in the homeowners private client personal lines arena, and the largest payout year over year. And this is not hurricane related or flood related, it's plumbing issues. Plumbing, water originating from within, plumbing related issues continues to plague the industry, and it's a lot more focus is being taken as a result on ways to prevent water losses from occurring, and specifically homes with small water losses in the past. Those past losses are being viewed with a lot more scrutiny go forward as a prediction of future potential loss, and action is being taken as a result. The note I would have on water losses is what can you do? You can do preventative measures, both maintenance of plumbing internally as well as installation of water flow devices, water leak detection devices, which can help proactively prevent those losses from occurring and prevent small losses from becoming really big losses. And I think those are measures that consumers can take to both protect themselves against loss, and even while an insurance company will pay out in the event of a loss, a water loss in particular, there's still the pain and time element that goes into dealing with a loss that cannot be made up for. And I think that's important to remember.
And one good thing that I would add is that Pure and other private client market insurance carriers, which we'll talk about a little further in the presentation, they're offering credits if you just go out and get these devices installed, right? I mean, that's the beauty of it, because they are saying, hey, go do this now. We will give you a credit on your insurance, and they'll know that your client or your family is taking the risk seriously.
Yeah, they are incentivizing families to be partners in risk, and I think that's important. The challenge is that credit doesn't always pay for the device up front, but they are incentivizing families to partner in the risk.
So we'll move on to risk management considerations and red flags, and these are simply, not too simply, but they are simply some recommendations and red flags that both I've seen in my position here at Whittier and David's seen across the table at his position at Willis Towers. So we have made a list of the areas of concern that we see most often, and we'll delve a little deeper into each of those. Okay, so there are some unique considerations associated with personal lines insurance. The first thing I will emphasize is when we are out doing any kind of due diligence for a family, or if the family office is taking on that role, we highly recommend that confidentiality is at the forefront. We need to make sure that confidentiality is strict, it's utmost importance, and the best practice in our view is to include, at least explore the idea of executing a non-disclosure agreement between the broker and the family. Keeps everything private, keeps your information from hopefully getting out anywhere, and also gives a little bit of remedy if the confidentiality is breached. The second point that I would want everyone to keep in mind is collaboration. If you're partnering with a broker, whether you're a family office of multiple families, a single family office or family business, or even individuals, you want to make sure you're collaborating with your broker, telling them everything that's possibly out there, discussing it. It does not mean it's going to be rejected from underwriting, but honesty is the best policy. Collaboration is essential between the family office and the broker. Otherwise, you risk missing something, and it could be something huge.
Well, your trusted advisors can only shoot what they see, and so if we don't know what's out there, it's hard to try and fix or help or prevent those losses or unexpected outcomes from occurring.
Exactly. So with respect to multiple households, questions that are usually asked, there's more than one. There's a primary, there's a vacation, there is a business, who knows. But basically what I like to know up front for talking with a broker is, how is title held? How is each home used? Who uses these homes? Is there any commercial purpose? Are we donating this home to charity as part of a silent auction or a live auction at a charitable event? Should there be any adjustments to ownership due to death, divorce, any other kind of, partition action and litigation? We just want to know what's the current status, what else is out, lurking, and how can we best address that. I would say that a good practice is also to run property profiles, because memories are great, but they're not always 100% accurate. And if there is no access to deeds or any kind of transfer documents, I would say it doesn't hurt to go and at least research title. Lots of families will forget to put a home back into a trust, irrevocable trust, revocable, whatever, if there's a refinance. So
Especially if there's a dissolution of marriage, oftentimes the trust and the entities behind it are forgotten about. The other comment I think that's important about the multiple households within the context of family businesses is when you have multiple generations of family that are being managed by the CFO or controller, or you have the business kind of taking over some of those personal functions of family management. From an insurance perspective, each household needs to stand on its own. It needs its own policy, it needs its own liability policy, its own umbrella. You can't intermingle multiple generations of family into one program per se. They can be managed in conjunction with one another, and I think that's important. But the complexity is managing multiple families as one and keeping them all separate but moving in the same direction at the same time. And I think it's a challenge that a lot of family businesses and family offices have, of keeping things organized and making sure that everybody is being treated fairly and receiving the correct amount of attention.
Right, and I would just add that, sometimes there need to be conversations with the family that says, this home might make sense because it's a beach house, vacation home, and it needs to be sort of in its own LLC. And we'll get into that a little bit later as well, but bringing up those considerations with your broker or, and then with the family, if your position is like mine where you're assisting in that and spearheading the effort, it's really important to kind of explore, yes, it's an additional LLC fee and a tax return, but the ownership is fractional. There are different sorts of tax you can take, but I would say where there's, any kind of vacation home with multiple owners, at least have the conversation.
Mm-hmm.
Quick question from the audience related to this. When you talk about multiple households, does the coverage that you're talking about, the liability coverage and so on, cover international second homes? How is that handled?
It can. It needs to be incorporated as part of the conversation. Fortunately, in the U.S., a lot of and I'm going to speak specifically to the carriers that I'm most familiar with, which the private client companies being Chubb, AIG, Pure, Cincinnati, and quite a few others actually. The liability language will extend to international properties. However, it depends on the country of origin. There's some countries that recognize insurance in the United States and have good relations in that sense. Mexico, for example, your insurance in the U.S. will not be recognized in Mexico, and so you need separate coverage for certain countries. It's country by country specific, but for a lot of the European Union, for example, you can use a U.S. umbrella policy to extend globally. It's case by case, but yes.
Thank you.
So we also see a lot of movement and conversation surrounding art and collectibles. I would say I highly encourage clients, and I believe David feels similarly, to undertake an inventory and consider appraisals when they're necessary. A large item, an heirloom, questionable art orientation. You see all the time in the news that there's something that was possibly, stolen during wartime, and the family that owns it now has no idea. So in terms of searching title, provenance, and origin, and getting a value on those pieces is advisable. It's not required, however.
Well, I think it's important too to pay attention to the art and jewelry and other valuable items that people have acquired either through inheritance or actively themselves. A homeowner's policy is good for a lot of things. It doesn't cover those high-valued items the way you might necessarily want it to. There's deductibles involved. There's causes of loss that can be limited, that for specific jewelry, for instance, you have limitations on even the best homeowner's policy as far as limits in the event of theft. And as a result, the collectible insurance is not terribly expensive. However, it provides tremendous amount of coverage that you wouldn't see elsewhere. And so I think it's important to at least be aware of what's out there. With real property cover, my general outlook has been that I'm more I'm okay with families self-insuring real property as long as they understand what's out there and are making an active choice not to insure it, as opposed to the hope that a homeowner's policy is going to be the end-all and be-all, which it often falls short, and there's disappointment at time of loss when you find out that your policy isn't going to cover the full value or going to cover for a peril that you thought you had coverage for. And so the consideration here is to consider it. It's important to recognize what you have and at least understand that there are options to provide specialized coverage for those types of items.
Right, and I would especially say, you know, where there's some sort of collection, like a coin collection, a gun collection. I know even wine is insurable. You just it's recommended that you schedule certain items at a minimum, and then you can also obtain blanket coverage for those times where you're not interested in preparing a list of items, or, you know, you maybe have too many things to list and it's kind of a big effort, but at least think about, okay, what are my top 10, what are my top 20 items, what are my, you know, top 10 pieces of jewelry. Even, I would say, I mean, you have experience, David, handbags can be expensive. Handbags
can be expensive, and they're definitely insurable.
Insurable, exactly.
Now, the blanket coverage, to expand on that just for a second, is I think important to have in conjunction with scheduled. Scheduled means you list individual items for coverage. Blanket, you list an aggregate limit for a classification, be it jewelry, be it wine, be it art. And you could buy 25,000, 100,000, 200,000, whatever that number is. But that aggregate limit is subject to a per item limit. And so what's nice about this is you don't have to list individual items. Anything that classifies in that schedule in the classification for jewelry is covered up to the per item limit. It's nice flexible coverage. It's coverage for you forgot to add something. It's not terribly expensive, but it's expensive enough that you noticed it when it's gone. It's very flexible in application and still carries that zero deductible, and it adds a lot of bells and whistles that your homeowner's policy just doesn't have sometimes.
So I would say it's most important that you consider scheduling over just a blanket policy. Moving on, when it comes to domestic employees in the home. We see this all the time, and there are varying considerations that we think about. One of the things on the family office side is how are the people paid. That's not necessarily something you need to consider with insurance, but sometimes it does come up when we get to workers' compensation. So there, with the luxury private client market, we have, there is some coverage for workers' compensation when an employee is injured on the job, or, you know, there's something that comes up. But
I think it's important to consider, because especially in the context of, as I see a lot of family businesses where they blend the business component with the household. Sometimes you find employees that work 80% of the time at the business also are taking on some tasks at the home, you know, whereas workers' comp picked up for that. And then for those employees that are strictly on the family's payroll, you know, are they erroneously being picked up on the business's work comp? Should they have their own work comp policy for the household themselves? Some states allow you to add workers' comp to the homeowner's policy. Some states do not. So I think it's important to just recognize where employees are being, how they're being employed, where they're working, and have it be part of the conversation. Again, as we mentioned earlier, if you don't mention it, you can only shoot what you see. There's problems out there that if they're not addressed, they can become big problems. And I think my biggest fear for families is, as coming from California views families that employ a full-time employee in the house, a nanny, a caretaker. They have the same obligation as a business with respects to that employee and the employment obligation.
Right, the enforcement of actual labor laws in California.
And they're subject to the same penalties.
Right.
So unless you address it on the front end, it becomes much more costly on the back end to fix it after it becomes a problem.
Right. And then I would just say, as a matter of just housekeeping with respect to domestic employees, when you're hiring someone new, or just someone's maybe transitioning from the family business to the family home, that you're at least considering a background check. I've had clients, request a crime policy on the employee just to make sure that there's no risk. There's a backstop if anything should go wrong. Usually, I know family business employees are loyal and very morally responsible. However, people change, times change, just something to be aware of.
And then some other unique considerations we see in the marketplace for the private client marketplace, and specifically businesses that are helping to manage the personal affairs. You have the high-valued automobiles, watercraft, and other policies. The higher the value, typically you might want to consider more specialized, unique coverage, both to ensure that the values are covered accordingly and that the performance is covered accordingly. There's liability implications. Same with watercraft, same with private aviation, fractional ownership of aviation. It all needs to be considered. There's a lot of moving parts that start to blend into the business portfolio, but should be handled separately, or maybe aren't handled as well as one might hope on the business side. And so it's important to just be aware of those and have the conversation and make sure both sides are aware of what's being done. And then same with the international exposures. The question was brought up earlier. It is a smaller world than it ever has been today. It's not uncommon for families to own real estate globally. And how is that being managed as part of a coordinated portfolio of insurance? And these are some areas that we typically see as common challenges. They're not atypical in this space.
Great. Okay, we have a little bit of a busy slide here. However, we're going to point out 4 or 5 of the ones that we find the most challenging, unnerving, and exposure.
And these are typically areas that, from an insurance standpoint, when it becomes appropriate to request a second opinion. This is where you might have outgrown a relationship you currently have, where you need a little bit more oversight or attention paid to certain items. These are things that tend to drive consideration and where problems exist. And so I think, as we were talking about yesterday, the most glaring one is when you have multiple brokers and multiple carriers involved with a single family. It's very hard to coordinate between too many moving parts, especially with multiple brokers or agents involved. It becomes the burden solely on the family to coordinate all the moving parts. And it's where I typically see the most glaring and problematic gaps of coverage, just because there's no coordination.
Right, I would agree with that 100%. And just to clarify, we are speaking about the multiple lines, multiple brokers on the personal line side. Usually, almost all the time, commercial is kept separate with a separate broker, and the personal lines are with one broker for the
They're two special arenas. Even within the same company, you're typically going to have 2 or 3 different people involved at each line, because each one is its own specialty practice within an organization, whether they're multiple organizations or a common organization. I think you do want specialists on either side, and anybody that says that they are everything to everyone, it could be posing a problem. I think there's opportunity. Some other areas to highlight on this page is the public profile and media exposure, which drives the liability of insurance. I think liability of all the things that go bump in a night for the family, it is liability. Real property, while an uninsured or underinsured loss would certainly be painful, it's not the financial time bomb that an uninsured liability loss poses for a family. That a liability loss is an undefined and terrifyingly large number sometimes. And so making sure that adequate limits are in place and making sure that everything's buttoned up accordingly and everything is included into that liability spectrum. And we'll touch on that a little bit later as well.
David, a question that's kind of relevant to that public profile or media exposure from the audience. What about defamation, or because family businesses can be very visible, and family members can be very visible. Any coverage of that under the personal lines for owners or leaders of companies, even if they're not in their business role when this occurs?
Yes, it's one of the benefits of personal liability as opposed to commercial general liability. It's why underwriting around personal liability can be a little tight sometimes. Personal liability is extremely broad. It is very broad, and there's very few limitations to how coverage is applied. They have no interest in applying coverage to business exposures, but when it comes to the individual, personal injury is included. It's a covered form of loss. There's plenty of examples ranging from Mr. Cosby to others where insurance was involved. Their personal insurance picked up coverage. They have a duty to defend. That duty to defend is a beautiful thing when you're being accused, whether
on the civil side.
On the civil side, whether it is whether they're just trolling or there's something legitimately there, the defense cost is as important as the liability limit. And so yes, personal injury can and should be included in the liability spectrum. Inferior policies can limit that, but broad and better policies and would have that coverage included.
Great, thank you.
And then, David, I know we talk about this all the time, but when does it make sense to maybe something's happening publicly, and does it make sense to reach out to your broker to adjust any limits that you might have if you know or can, have an idea something might be changing?
So when it comes to personal umbrella, how much is enough? And when is it appropriate to increase those limits? I think there is a lot of ways to address it, but I think the public profile is an underlooked but easy tool to utilize with respects to how much umbrella should one purchase. What is someone going to Google about you or your client and find out online? What is the average person that you might interact with on the road going to think that you are worth? What is their personal injury attorney going to think that they can get out of you? And so if you've had any recent liquidity, if you live in the neighborhood that has all the nice homes, drive the car that is rather expensive, if your lifestyle presents itself that you have assets to lose or assets in general, I think it's prudent to review and increase your liability. Some broad rules of thumb with respects to how much liability is enough. There's some that would say that you should match your personal umbrella to your net worth, dollar for dollar. I think that's a little overkill personally. Other schools of thought say 50% of net worth is a good starting point for personal liability. I think that's applicable sometimes, and I think somewhere in between there's a balance between risk, your personal risk feelings and risk tolerance, premium outlay, and your overall net worth. And where those three come together is a conversation, but I think something certainly in excess of $5 million is an easy recommendation for anybody. And when you start looking at limits above that, you start having to look at external factors, what your profile is online. The online world has made the world a much smaller place, and I think it has to be considered to some degree as well.
Our favorite topic, dwellings under construction.
Yeah. So this is another area that I think is often overlooked, is often uninsured or underinsured, and it doesn't pose a red flag until there's a problem underway. And I see this all the time as homes are maybe not ground up, but major renovations are underway, where it's nearly a total knockdown, and the home insurance was never modified to reflect the course of construction. You pay a little premium for the course of construction policy, but on the upside, you have all the bells and whistles that you want there. Homeowners policies tend to have strip away coverage if there's a certain amount of renovation underway at time of loss. And I think the most prominent one is the deductible goes from whatever you had set it at and agreed to at policy inception, becomes a percentage of the dwelling limit. So if you have $1 million dwelling limit, your deductible at time of loss, if your home was under construction, is now 10%. And that's a much higher number than people were anticipating.
Right.
And it's a very easy way it's something easy to fix, but often overlooked.
It's something, in my experience, it's super easy to add, and you just keep, an eye on the timing. When is it going to be finished? And making sure that final inspection happens to make sure that the builder's risk premium can be removed. It's a little bit of a dance, but it's completely worth it to get that, exact right coverage for what's happening in that dwelling at the time. And it, in my opinion, helps most people sleep at night.
Mm-hmm. Well, it's also important that it's done at the inception of the construction project.
Yes.
Once you get too far into demolition, it becomes much more costly to try and get a new policy in place,
right,
as opposed to doing it with a little advance notice.
Yes. So essentially, if you have any of these concerns on this slide, please do not hesitate to ask questions of your broker or of us.
So what we wanted to talk about here is where the business insurance and personal insurance start to overlap and where some crossovers are, where the intersect of the business operations and the family themselves reside. And the property insurance is certainly one of them. Mm-hmm. Ownership of ownership of the commercial buildings, either leased back or for investment purposes elsewhere, is an area that the family themselves can all of a sudden be exposed without and relying on the business insurance, and there needs to be some coordination and understanding from the personal side. D&O, E&O, and crime. These are easy ones with respects to, on the D&O, you have the Side A coverage where piercing the veil, where you want to protect the family as individuals and make sure that policy has been reviewed, is up to date, and everyone's comfortable with what's being purchased there. And the crime I would highlight in the sense of a lot of family businesses start transacting on behalf of the family as individuals, and you want to make sure that those transactions have coverage if someone was to commit fraud, embezzle, or steal otherwise as a result of those transactions that they have access to, whether they're business related or on behalf of the business.
Or personal, yeah.
Cyber is a growing conversation. It is evolving day by day. I think it's important to at least understand what coverage is available, and especially, again, as businesses take on more and more family, personal functions, what crossover is there, what personal information is being exposed. And cyber insurance, as Kim and I have discussed recently, it is available in the personal lines arena. It's not widely available. There is a difference between identity restoration and cyber insurance. Identity restoration is simply the concept of restoring one's identity after an event occurs, where cyber insurance, some carriers do provide it, and it is first dollar reimbursement for physical loss, which is a much broader approach to the coverage itself. A lot of nuance here, and it's really, I wanted to highlight this as an area that at least needs to be looked at, understood, and I think like everything on the insurance front, you don't need to insure everything to full kilt. It's important to understand what is insured and make decisions, active decisions, what you're not going to insure, as opposed to finding out at time of loss that you never had insurance.
Right. I mean, it's especially happening a lot now with some of my clients. Identity theft is happening, and that's covered through LifeLock, Experian, any of those credit monitoring or credit freezing sort of programs. But what they're, asking, what else can I do? Well, this is another thing, is the cyber, because we've seen clients with somebody literally on Amazon putting things in their cart and just messing with that person's entire Amazon account. So that's where we're going to look to the cyber coverage and hopefully try to get some relief there. But at the same time, I'm also, on behalf of a family, looking at now identity remediation.
Yeah. No,
Kim, you mentioned the that LifeLock and so on, but and cyber insurance for businesses, I guess. But can you buy it for yourself personally too? Cyber insurance that's different.
It is out there. It's specific to a few carriers. It is out there. We're starting to see actual product be developed for individuals. It's contingent on the home insurance. The home insurance provides you access. I know Pure, for example, Cincinnati and some others, Chubb, are developing these products, and they're growing in breadth and the offering itself to be more similar to what you would find in the business setting, but available to the individual. So it's an area that's still growing, but it is starting to become a little bit more prevalent and generally available to the public in general.
Right, within the last 12 months, 18 months.
Yeah.
It hasn't been that long, David, to address your question, but it's also provided a lot of peace of mind because I feel, at least I'm seeing some individuals here and there being subject to a ransom, situation. And so, yeah, we're trying to use all the weapons we can to fight any kind of cybercrime against our families.
Unfortunately,
yeah. Sure.
And so the last item that the business insurance and personal insurance crossover is the corporate vehicles. A lot of times I see, and I know Kim, you've seen as well, the businesses own cars in the company name, but they're for use of the family members. And so understanding what those vehicles are, how the business insurance policy is written, whether it's who's a permissive driver, is it just the employee, or does that permission extend to family members, children, others, as well as does your personal umbrella pick up any excess coverage for your liability while driving that car? If the business insurance if the business is sued following a loss and the individual is sued, is there coverage on the individual? And there is ways to do it. It just needs to be addressed. And I think that's a overlooked arena a lot of times where I, as a broker, am not being made aware of those cars because it's assumed it's insured elsewhere. Whereas if we just had that conversation, we can ensure that it's included on the umbrella, and at least there's comfort of where coverage resides and how it's applied.
Okay, let's move on to asset protection in the context of insurance. So I will just start with saying, we're speaking of entities and trusts from an asset protection standpoint within the context of insuring a family appropriately. So these are personal entities that we're talking about, not corporate, but entities that are formed for various reasons. Any kind of trust, LLC, family limited partnership. It's really important to know, for purposes of a family office, family business, knowing what these trusts say, what is the operational function of each trust, what property is owned in the trust, are the entities properly formed and maintained. I can't tell you how many times I've seen an LLC that owns nothing, and that should own something, but maybe it's just been overlooked. It's a very fast-paced, busy world, but sometimes we come up with these unfunded trusts, unfunded entities, or the wrong thing is in a trust or another entity, and we're sort of unraveling and fixing that at some point. So
I think there's a lot of reasons that families use these entities for asset protection, and there's some misalignment sometimes with intent with respect to how these entities are formed and utilized, and then the insurance is either foregone altogether because we think there's an LLC in place and you can't get at me,
right.
Or another common error, which we'll talk about, is they're just not included. But generally speaking, there's a lot of reasons to do it, and it's important to integrate insurance
right.
as part of the asset protection conversation.
Okay, insurance as the first line of protection. So here we wanted to talk about just sort of, how can we protect and just come up with some simple, maybe the first couple of items on here are what David and I would refer to as low-hanging fruit.
Yeah.
Just being detail-oriented and paying attention can help, a family be properly covered.
That's correct. Insurance as a first line of protection, it kind of goes back to my previous statement that insurance needs to be integrated with an asset protection strategy. And insurance is the first line of defense. It is the defense dollars that when, an individual or that entity gets named in a suit, that's the duty to defend, which is what we want from our insurance company to come out and, start putting some money on the line with respects to legal fees and other. Entity integration is the most important part, low-hanging fruit. If a property is held in an entity, a trust or an LLC or other, it needs to be named on the insurance policy. If it's not named on the insurance policy, there's no coverage. I think the scarier side to that is if you have an LLC in particular own a residential property, the property burns down, but the entity is not listed on the policy. The individuals who are named on the policy legally technically can't be paid by the insurance company for that loss because they don't own the property. It's XYZ LLC that owns the property. And so therein lies kind of the low-hanging fruit Kim was talking about of just making sure that all the entities that should be named are named. And that they're named appropriately. And there is a distinction between named insured, additional insured, and additional interest. They all have different implications when it comes to insurance. Named insured, for example, will typically provide that entity or individual full access to all limits of the policy. Additional insured on a personal lines policy can be a little bit more specific. Sometimes it's providing coverage only to the property limits. Sometimes it's only providing coverage to the liability limits, or sometimes both. But typically what we see is that additional insured status is only providing limits of insurance for real property for the dwelling limit and the other structures limit. It doesn't provide personal contents coverage. And so there's just some considerations there that need to be made aware of and made sure they're being talked through. And then we listed additional interest as another line item there because it is something you see that's very prevalent in the personal insurance arena. It's a readily available endorsement to policies, but all that is a reporting provision.
I was gonna say, all I get is a copy.
Yeah, that just tells you that there's a policy there and you'll be notified if it gets canceled for non-pay. And sometimes there's a misconception that because you have additional interest status in a policy, you have access to the limits at time of loss, and we just want to point out that that's not true all the time, very rarely. Insurance to value is another important component of the integration of insurance as first line of defense with respect to real property. It's important to note that there is a difference between actual cash value and replacement cost. I'll even go a step further to say market value.
Right.
Actual cash value conceptually is old for old, so you have a depreciated asset, be it a home or a sofa or some other piece of real property, you're going to get paid the current value of that, depreciated value of that. Replacement cost is new for old, and so that is the current value of what it would take to replace that.
It's usually rebuilding a home.
Rebuild a home, yeah. or even personal property, provide a new replacement today. And then market value with respect to replacement cost, the comment here is that there is a difference. A lot of times when individuals come to me and say that their home has a market that sells for $1.5 million, why are we insuring my house for $1.2 million? Replacement cost is not directly correlated with market value. Market value is what someone else will pay for the property, including the land. Replacement cost in the context of insurance and in the context of a home is what is it going to take to rebuild that home from the foundation up. And while they're not always correlated, sometimes they move in the same direction. Depending on market conditions, sometimes they move in opposite direction. Right now, for example, we're seeing that the replacement cost is increasing year over year. Exponentially. Especially COVID's kind of highlighted that a little bit, as there's been delays in labor material, shortages in labor material. It's causing some increased cost of rebuilding, whereas the market, depending on where you are, might not be moving the same direction or moving as quickly. And so it's just important to understand the difference between the two from an insurance standpoint. Additionally, with respect to insurance as a first line defense is to pay attention to the catastrophic potential, the losses that are out there and that they're covered. Because all these losses, fire, wind, flood, are not automatically covered or have some limitations on a traditional homeowner's policy, depending on where you are. And so it's important to have those at least identified and understand what you are buying and that the coverage that you want included is in fact included.
And then in terms of carrier selection, it's really important to vet the carriers, right, and to explore private client versus mass market. Private client is not for everyone, but it's very valuable for the families that we work with, and we don't use it for every single insurance policy all the time. The pros of a private client carrier, as David mentioned, Chubb, AIG, Pure, the customer service, the customer claims experience is fantastic. It is very well worth the dollars paid for premium because those people who work in those departments are trained to treat our families with, kid gloves, making sure they understand the process, making sure they're communicating, not just responsive, but also proactive. And I've personally lived through several claims and can attest to that benefit. Also too, sometimes the private client carriers will give you a little bit of flexibility. Like I said, with the, blanket jewelry coverage, it's a little more, I think it's a nicer overall perk.
Well, I think in addition to the kind of the concierge component that they really build into their client-facing customer service, the policy language is robust.
Very.
It's the private client companies, you have to qualify into them, but you're in an actuarial pool of similar client profile, and as a result, you have broader terms, conditions, and limits. It's some of the broadest coverage you can find in the marketplace. And then you have to weigh, is it worth sometimes, A, do I qualify, and B, is it worth the increased premium?
Right.
My general opinion is it is. But it's understanding that what we see a lot is families that had, when they graduated college 20 years ago, they went out and bought an auto and a home policy because that's what they needed to do to satisfy their lender and the DMV.
At the time. At
the time. And it was appropriate for them at the time. And 20 years later, lifestyle has changed drastically, but a lot of their advisors, their insurance has not. They're still using the same old insurance that they had 20 years ago when lifestyle has marched forward significantly since. And so it's just making sure that the carrier selection is in line with the needs of the family.
The current lifestyle.
And so the next part of this is, we kind of talked about in the market outlook, is this proliferation of the non-admitted spaces. A lot of carriers are non-renewing policies throughout the United States right now. Anything fire exposed, wind exposed, it's become very problematic, and we've seen a huge jump in the non-admitted Lloyd's of London, for example, policies out there. And the comment here is to be cognizant of the terms and conditions, because nothing is standard in the non-admitted market. They can charge premium as they see fit, and they can also build policies as they see fit without having to submit to a Department of Insurance for review.
Yeah, there's literally no oversight.
There's very few oversight components, and what we're seeing is some funky terms and conditions being created, special wildfire deductibles, elimination of fire altogether, or wildfire altogether from a policy, or capping it at, let's say $1.5 million of payout in the event of wildfire. And we also see some more softer, the lesser looked at endorsements and bells and whistles being stripped down. Things like building ordinance, water backup, how your contents are covered. They slip in every once in a while, the actual cash value valuation versus replacement cost. So the note here is just be cognizant. Be aware that what you're buying is what you think you're buying, and it's not just a policy. They're not all built the same.
Right. That's why I have you to explain this. So common underwriting challenges. So we'll just go with a couple here, so hopefully we'll have time for questions and maybe a case study. So we just wanted to highlight some of the most common questions that will come up during underwriting. And I think when we were preparing for this, the biggest lesson to take away is no commingling.
That's correct. So as I mentioned before, personal lines is very broad, especially on the liability side, and they do not want any commercial exposure in the entity. And so it's perfectly fine to have LLCs and other entities owning personal property, residential property, so long as they don't have income or they don't derive income from non-residential property sources, i.e. a business or otherwise. And so by keeping them separate, you gain access to the personal line space and then can ensure the commercial exposures elsewhere. Some other kind of red flags that underwriters look at, and there's questionnaires that have become very standard these days, that I would highlight is the employees in the entity, making sure that that the entity employees are domestic employees and not doing other activities on behalf of a business or family or generating income. And then ownership of more than 5 to 10 residential properties. And the comment here is that a lot of personal umbrella policies limit the amount of rental exposures that they will permit having on an umbrella. And so it's okay to have more than 5 or 10 investment properties. You just need to understand that you may need to insure them a little bit differently. And a commercial policy form may be better suited for those investment properties as opposed to trying to get it on a personal umbrella policy. And so really it's just, I think as Kim said it initially, making sure that personal exposure and commercial exposure are segregated and kept separate and not out of simplicity thrown into the same entity because it's there and waiting for
Convenient.
it. Convenient, yeah.
Okay, well, we have about 4 minutes left. Kim, what would work better, a quick case study or a question or two?
I think we've huddled up, and probably a question or two is appropriate, just because I think the case study would bring us over time.
Okay, we want to be cognizant of everyone's time. So the first question that I have is actually the very first question that was asked, and I've held it this long, but I thought it was interesting, the plumbing issue, David, that you spoke about at the very beginning, as the internal plumbing being one of the leading causes of that kind of insurance being pulled. Is that occurring in newer homes or older homes, or is there any feeling that...
All the above.
Vacation homes where nobody's there, it's happening, renovations,
I see it in newer properties. It falls under construction defects, but it needs to be subrogated, so it's still a loss that the insurance company burdens. I see it in older homes. I see ice makers as the biggest proponent of that loss sometimes. It's a very common common appliance that we see that loss, and really what happens is those ice makers need to be maintained. They need to be serviced every couple of years, but so often we buy them, put them in our house, and 10 years later they're still there and never been looked at, never been serviced, never been touched, and those internal parts fail, and that's where we see water losses occur. And then in older homes, it's just general wear and tear and plumbing related.
Right, trees.
Yeah,
things like that.
But it is the most common. It's the most common call I get when there's a problem at someone's house.
Yeah.
Okay, interesting. So it doesn't really matter the new piping that they're using. I know there were plastic pipes, copper pipes. They all fail.
Mm-hmm.
Right, or someone leaves water on that shouldn't be on, and it's just nobody knows that it's leaking because it's under construction. And so literally that is an actual claim that we've dealt with over the last 2 years. And it's just been, unfortunate for the client, and it was just a total...
The insurance company will always pay out that water loss. They'll never be able to reimburse you for the time and pain that dealing with a loss is.
True enough.
Right. And your premiums will reflect that for a couple years, reflect that pain.
Okay. And then to take us out, because we've got 2 minutes left, how often should you be reviewing your insurance to increase or adjust or decrease coverages? What's best practice?
Generally speaking, if you have a complex portfolio of stuff, be it homes, cars, lifestyle, it should be an annual meeting. It should be an annual discussion. For lesser complex, maybe you can go every other year, but there should at least be some eyes being put on the renewal to make sure that what you had this past year is reflective of what you have going forward. But certainly for the more complex families, an annual review, and for those families actively engaged in ART acquisition, for example, it's not uncommon to have a quarterly plan discussion just to make sure that what we have in place is accurate and up to date.
Right, and I would just add that when your family office, whether it's a multifamily office, a single family office, when you're sort of taking this on in the onboarding process, it's one of the things that you should absolutely be reviewing is the insurance. We do that for every client that is onboarded at Whittier, and we use independent brokers because we do not want to have any involvement. We just want to take it out to brokers who are going to take it to market, take the program out to market, and give us an opinion, and we can get a second opinion if we'd like. But going forward after that onboarding review, we are at least annually, but to David's point, there's sort of ongoing discussions going on all year when there's art moving, there's art being acquired, or there's jewelry or watches or any kind of items coming into the mix. There's more frequent contact, and yeah.
Great. Well, thank you both, Kim and David. I thought this was really interesting, and I'll personally be reviewing my policies with my wife and our insurance broker after this. It scared me a bit, but I hope everyone found this to be a really valuable expenditure of time. As I noted at the beginning, we will make sure that a copy of this presentation is emailed to everyone after the webinar. So again, Kim, David, thank you for the insights and the expertise, and thank you all for attending today's webinar. We look forward to seeing you at the next one. And with that, I'm going to end this webcast. Good day.